what does cap weighted mean as opposed to equal weight? 40% of the S&P 500 is made up of just the top 10 companies. Because of that, it's not a bad sign that the equal weight S&P does better. Good morning, and welcome to Life in the Markets. I'm Stephen Rohr, Wealth Manager here at the Life Financial Group, and we're looking forward to celebrating the 250th birthday of our great nation, the United States of America. This week in the market, this past week, we saw the S&P 500 and the NASDAQ decline by 1.95% and 4.24% respectively. For the NASDAQ, this was actually the second worst week for this year. The Dow Jones Industrial Average, however, with its blue chip companies, it managed a third week in the black by a photo finish, just by a hair, only up 0.59%. However, the interesting index to note this past week is the equal weight S&P 500. So while the S&P 500 cap weight, so the normal S&P 500, it was down almost 2 percentage points. The equal weight S&P 500 was up 0.17. Well, more than a 2 percentage point difference there. Given the over-representation of the top 10 companies in the cap-weighted S&P 500, it's still about 40% of the S&P 500 is made up of just the top 10 companies. Because of that, it's not a bad sign that the equal weight S&P does better. Now, you might ask, what does cap weighted mean as opposed to equal weight? Cap is shorthand for market capitalization. Market capitalization means the value of the company's shares on the market. To weight the index by cap, or market capitalization, means the companies who are worth more count for more of the index's return. And there is a logic to this. If you are attempting to get a sense of the economy, and a company represents a larger share of the economy in jobs, in revenue, it pays more taxes, it generates more value in goods and services, then it does make sense to give them more of a weight in the index because they represent a larger share of the overall economy. Now, the other way to weight an index is to equal weight it. And this just means every one of the 500 companies in the index, or thereabout, gets an equal weight of the index. The share price of a company might go up for reasons other than the actual value that it's adding to the economy. Most often, when the share price starts to explode, investors are excited about potential future value that the company is going to add to the economy and ultimately to its shareholders as well. However, sometimes the share price starts to grow really just because it's growing. When this happens as a human decision, it's generally because if other people are getting rich, we don't want to miss out. But more and more, the share price can grow mechanically just because it's growing, and that is because the rise of index investing. So when you are in an index fund that seeks to track a cap-weighted index, remember, you can't invest directly in an index, but you can invest in funds that seek to track an index. So when you invest in one of these index funds and the index fund is cap weighted, suddenly 40 cents out of every dollar that you invest might be invested in just those top 10 companies, as the current S&P index is made up of. Now, this might make a perfectly reasonable and prudent portfolio, but when you multiply that by millions and millions of investors, suddenly it has the potential to overexpose the market to a very small number of companies. All that to explain again, it is actually a good sign for the health of the overall market that the equal weight S&P 500 does better. It means that the growth and the investment dollars are broadening out. And as a wise farmer knows, don't plant all your fields with only one crop. We had another reminder of this lesson this week from the major South Korean index, the KOSPI. Now, the S&P's concentration is nothing compared to the KOSPI. Two companies, Samsung and SK Hynix, comprise 45% of that index. Only two companies. It saw a major correction on Tuesday. It dropped 10% in one day. Now, because these two companies are major global semiconductor companies producing for AI needs, it did trigger a tech drop across the globe kind of throughout the week. Now, there is a staggering demand for semiconductors, particularly for AI applications, and there is an incredible opportunity for AI technology as it starts to transform the economy and how we do business. But things can only climb so high and so fast without experiencing some serious G-force sickness. It's not bad for these to equilibrate a bit. Oil is down, thankfully. It is under $70 a barrel again as of this morning. And this is with the market assuming that things are going to work out between us and Iran one way or another. Now, as we say this, there were more strikes back and forth this weekend. And subsequent, this will be the end of Iran if, blah, 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 social media posts from President Trump. However, we and the market broadly are beginning to tune these things out mostly. In other news, the former Fed chair, Alan Greenspan, passed away this week at the great age of 100. He was a towering figure in the world of finances and economics for decades. He was appointed chairman of the Federal Reserve in 1987 by President Ronald Reagan. He served for almost 2 decades, and he served until 2006. This made him the second longest tenure serving Fed chair in history. He was firm in his policy of not broadcasting the future moves of the Fed. His successor, Ben Bernanke, changed tack and began a policy of forward guidance. Now, we talked a lot about this in last week's episode, so I'd encourage you to go back and listen to that for more details. But in simple terms, the forward guidance being the Fed saying, this is what we're planning on doing over the next several quarters, and the market being able to respond and price those things in accordingly. The reason it came up last week is because the brand new Fed chair, Kevin Warsh, has made it plain that he wants to stop the forward guidance policy and return to the Alan Greenspan model. Now, because the new Fed chair is resuming some of Greenspan's practices after almost 2 decades of not doing that, Alan Greenspan's passing feels particularly poignant. Now, what are we to learn from this week as we look back and as we invest going forward? Well, divide your investments prudently, diversify, and don't chase after the shiny object. It's easy to get distracted by what's working for other people, but sound investing is looking at fundamentals, staying with a good long-term perspective, and operating off of a sound structure of your portfolio, and not just chasing after the newest, highest flying item. What can we expect this week? It will be a short week. The markets will be closed on Friday, July 3rd, in celebration of our nation's 250th birthday. As we celebrate this, we can look back and be humbled and grateful for all the blessings that God has bestowed on us. And it is also right to look back on our faithful Christian forebears who sacrificed, in many cases, their lives, their fortunes, and their sacred honors for the truths that they held to be inalienable. May we be inspired by their example to do hard things for the sake of our posterity. We should also be reminded that we shouldn't be here as the United States of America. There was no way that the colonies should have been able to defeat the greatest military power in the world at that time, Great Britain, let alone that we should survive as an intact nation and flourish to become the global superpower that we have. So, as we close and think about that this week, I think this passage from Psalm 33 is a good reflection on God's working in the nation. Let all the earth fear the Lord. Let all the inhabitants of the world stand in awe of him. For he spoke and it came to be. He commanded and it stood firm. The Lord brings the counsel of the nations to nothing. He frustrates the plans of the peoples. The counsel of the Lord stands forever, the plans of his heart to all generations. Blessed is the nation whose God is the Lord, the people whom he has chosen as his heritage. The Lord looks down from heaven. He sees all the children of man. From where he sits enthroned, he looks out on all the inhabitants of the earth. He who fashions the hearts of them all and observes all their deeds. The king is not saved by his great army. A warrior is not delivered by his great strength. The war horse is a false hope for salvation, and by its great might it cannot rescue. Behold, the eye of the Lord is on those who fear him, on those who hope in his steadfast love, that he may deliver their soul from death and keep them alive in famine. Our soul waits for the Lord. He is our help and our shield, for our heart is glad in him, because we trust in his holy name. Let your steadfast love, O Lord, be upon us, even as we hope in you. Let this be a reminder and an encouragement to us that our hope is not in the market. Our hope is not in the portfolio that we invest in. Our hope is not even in our great nation, which has been so blessed from God and benefited so much from the sacrifices of many great people who have gone before us. Our hope is ultimately in the Lord. He is our mainstay and our support. So be encouraged this week as you celebrate with your family. We look forward to seeing you again next week. Please like and share with anyone who might benefit from this, and we will see you soon.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.